Welcome to the Scalable Real Estate Investing Podcast, where we discuss the most scalable strategies, tools, and approaches to successfully invest in real estate. Learn how to make the most impact of your time, automate your real estate investing business, find off-market deals with minimum time invested, and leverage your capital to create as many income streams as possible so that you can achieve true financial independence. Thank you for tuning in. I'm your host, Mason Clement. Hi everyone, Mason Clement here. Before we get into today's episode, I wanted to ask you one question. Are you sick of the wild swings in the stock market and ready to try something different? Did you know that investing in stocks actually put you at the very bottom of a company's capital structure, meaning that there's practically 0% chance that you're going to get any of your money back in the event that the company files bankruptcy? That basically you're putting yourself in the riskiest position for a questionable return. Personally, I hate the unpredictability and just waking up and having half of my investment gone when I didn't do anything wrong. So what a lot of people don't know is that you can actually make higher returns on a consistent basis by investing in the opposite end of the capital structure, which is actually the safest place to be, which is on the debt side in a first lien position. And you can do that by investing in real estate, and specifically investing with my company in notes that are backed by the land that we purchase. So if you're ready to diversify your income stream, go ahead and go over to scalablerei.com and click on invest in the top right corner. There you're going to find a form that you can fill out to determine if you're eligible to invest with my company, Celion Capital, and we'll be reaching out to you to schedule an introductory call and speak more from there. So thanks a lot, and let's jump into the episode. All right. Hi, scalable investors. Thanks for joining us for another episode of Scalable Real Estate Investing. I'm your host, Mason Clement, and today we have Joel with us with Brit Properties, which focuses on industrial real estate assets in the Chicago area. He has a long track record of success, so I'm sure that we're going to get a lot of gems out of this conversation. So let's just jump into things. Joel, what's going on today? How you doing?
Hey, Mason, everything's going well today. I'm going to be enjoying being with my granddaughters tonight when we're done with this, and I am so looking forward to that. They're 4 and 1.
Perfect. Yeah. Like we were talking before we started recording. I have a son. He's about the same age, 1.5. So definitely can relate. Not in the same way that you can with the grandchildren. So
the grandchildren are great. We get to go visit, and then when they start screaming, we tell the parents, "You're in charge now."
Yeah, just almost like the Disney World's parents or something. Just when things are good, you can be around them, but otherwise, just hand them off.
Hand them off. It's really great. Yeah.
Okay. So what I like to do with all my guests when they're on the show is, in case listeners are not familiar, is talk about your real estate journey and what got you ultimately to today and talking with me. So let's start with that.
Yeah. So I'm 64 and I started in the real estate business when I was 22. So I've been doing this for over 40 years. Out of college, I graduated from the University of Michigan in Ann Arbor, and I applied for a job on the phone. The company that I applied to was called Podolsky and Associates, and they were in the Chicago market. They were industrial real estate owners. They owned 6 million square feet, 84 industrial buildings, and they had some vacancies. It was 1981. Interest rates were 17%. And at that time, companies were just struggling to stay in business because if they borrowed, their interest rate was too high or business was slow and people were just holding off on everything. I'd make cold calls to fill up their vacant buildings, but not just any kind of cold calls, in person, door to door, stopping at industrial companies and walking in and asking them if they wanted to move. That was how I started. And I would say that in my first 6 months, I probably made 500 door-to-door stop-ins. And the Podolskys had 10 vacant buildings of their 84, and I filled up 9 of them door-to-door, convincing neighbors that they should move to another industrial building down the street.
And was it primarily your pitch, like just the rates or amenities, or how'd you pitch that?
Sometimes with cold calling in person, it's better not to jump into what the details are right away. It's better just to start a rapport with somebody. So let's role play. Pretend you're the owner of a building, and you're thinking of selling the building and moving to a larger building down the street. So I'd stop in and I'd say, hey, are you the owner of the company?
I would say no. Who's asking?
Oh, okay. So who do I talk to that's the owner? Because we have a building 3 doors away that's vacant, and I want to find out if you guys might consider moving. If you need new space, bigger place, smaller place to run your business. Who would I talk to? And then usually, if I didn't get thrown out by whoever I was talking to, they would introduce me to the owner of the company, or if it's a big company, to the branch manager. And then I would say to the branch manager or the owner, I've got a building 3 doors away. It's 15,000 square feet. Would you consider moving? And then they'd say, no, not really. And then I'd just open the conversation. What does your company do exactly? And how did you get into the business? And you get them talking, and all of a sudden they say, hey, why don't you come into the conference room? Let's talk. So it's opening the conversation and being interested in them. And that's how I did it. And that's how I still do it. Literally no joke. We're buying 3 buildings in the city of Chicago, 3 industrial buildings where they produce juice for people who drink like punch and orange juice and that kind of thing. And there's 3 buildings in a row. And because we're buying those buildings, I stopped at the 2 buildings on either side of those that we're buying. So I stopped on the one side and I talked to the owner of the building there. And then I went to the other side of the 3 buildings and talked to the owner there. And I'm not able to buy either of those, but I know the neighbors.
Okay, so in terms of sourcing new properties to purchase, it's still the same strategy, or do you also use brokers?
We sometimes work with brokers. I would say that of the 90 something buildings, we've bought almost 100. We have sourced off market by stopping in and saying hello to people. We have sourced 90 of the 95 or 96 buildings. So 5 buildings have been brought to us by brokers over the years.
Okay, well, it's pretty easy then to determine the allocation there.
It is. It is. And I have a partner who goes door to door. He's 45, so he's a little younger and has more energy than most people. And I have a son who's 28, and I've taught him how to do it. And he goes door to door. In fact, I just got off the phone with him and I said, you've got to go talk to the neighbor of this particular building in Chicago. Would you go there today? And he got in his car and he drove there and he went to see them and he figured out who they were and how big the building was and what the amenities are. And we're going to try to figure out if they might sell their building to us.
Okay, so we talked about how you would just speak with or start building a rapport with a potential tenant, but in this case, how does it go? How does the conversation go in terms of trying to buy the property?
Yeah, so it's different. It's not would you move to a building that we own? It's actually, would you consider selling your building? And most people say no. We have to go to 100 places where they say no to get one where they say yes. And basically, nobody wants to tell you anything in the first meeting because they don't know who you are. So I've walked into places and they say, come on in. And I tell them we buy buildings, we're syndicators, we have 200 investors. And by the way, we pay all cash. We have no mortgages on our properties that we buy now. So I say, we'll buy your property all cash and we'll lease it back to you, or you can move out and we'll find a new tenant. And they say, oh, okay, sure. And then I asked them a lot of questions. I think it was Dale Carnegie who said, interested is interesting. So if you're interested in somebody and you're asking them the questions, they think you're interesting because you care about them. And I do. I want to learn about people. And that's the way that I do it. And they usually then say, okay, well, we're not that interested. And then the next day, I have their business card. I picked it up and the phone rings and I pick it up and I say, hello. And it's like, hey, this is Jim. Remember you stopped in yesterday to meet me? Yeah. Well, we didn't want to say anything because we wanted to figure out who you were, and we looked you up on the internet. We actually do want to sell our building. And that happens a lot. They just don't, they hold their cards close to their vest before they open up because they don't really understand who they're dealing with until they research. And that's how we find our deals. And it's been 40 years of knocking on doors and finding off-market deals and then satisfying whatever it is that the owner needs to satisfy to sell their building. Maybe the family that owned the business sold the business, and now the family owns the building and they lease it to the company that bought them out, and they want to get rid of it because it's in their estate and they just want to not own real estate anymore. That 9 out of 10 times we buy from families who used to own the business that's in the building.
Okay. And how do you usually structure your syndication? You said you have 200 investors and just buying cash. So what does that usually look like in terms of like cap rates you're looking for and IRRs, hold periods, stuff
So
like that?
we put together a private placement memorandum, and it's very simple. It's usually 60 pages. And inside we have what the deal is, how big it is. So for example, right now we're putting together a $13 million acquisition of these 3 buildings. And I think I have my PPM. I can grab it here. Here it is. PPM. So it says 8% return, long-term leases to existing tenants. And then I send it out to my investors, and they call me and they say, "Hey, Joel, I like this one. I'll put 100,000 in."
Okay. So I guess that's about it. That's simple. Don't need to overcomplicate it, huh?
Choking on my coffee.
Oh, no worries. Take your time.
Okay. Yeah. So, yeah. How about you? Tell me about this. See, this is what I do. Tell me about you and your situation.
So about 2.5 years ago, I took my real estate career seriously. This was after I had bought 2 single family greenhouses and they weren't really cash flowing. And I decided I need to do something else. So I looked at multifamily and self storage and joined a self storage mastermind, and then pivoted to land and really focused on land for the past 2.5 years. And primarily because I saw that as a vehicle to generate enough cash to leave my day job. So I did that a little over a year ago. And now I'm back to, man, I really need something that's generating consistent cash flow, and I can shield that income with depreciation. Kind of no-brainer stuff, the reasons people start real estate investing. So actually right now I'm focusing on hotel acquisitions, and that will be my first type of syndication, but I don't have an active syndication raising capital for right now. But that's the overall goal, is to buy 1 hotel before the end of this year.
So what do? Do you put debt on it?
Yeah, that's the plan. Probably aiming for like 7 to 8% interest and like a 10% cap rate, and go from there.
Got it. And do you have a list of people that you think will invest?
So my strategy right now is to focus on partnering with other capital raisers that have existing relationships with investors. I do have a short list of people to directly answer your question that probably could account for about 200,000. But if I'm expecting to raise $1 million of equity, then that's obviously not going to completely fill the hole there.
When you work with capital raisers, is it just that they do it to get people in a good deal, or do you pay them something?
Yeah, I'm definitely open to giving them some equity in the deal.
Uh-huh.
It's just obviously every property is different, and it just depends on deal by deal basis.
I see. So what we do that's different also is we have a fund that I put together of my 40 very close investors. And that fund is set aside. Right now it's sitting in T-bills, earning luckily 5%. We use that money to go buy a property. And then after we own the property, that's when we syndicate it. So we don't run around like scrambling trying to syndicate before we buy most of the time. We usually own it, and then sort of handpick investors as we go. Investors come around when they come around. They don't necessarily come around when we need them to. So I convinced this group of people to take a part of the GP with me. So they share in our GP fees and our GP promotes. And we use that money to go buy a property. So for example, last year we bought a property for $2 million. And I had one investor put $1 million in, and then we raised we put in the rest of the money to buy it from our little fund, which was another $1 million. And then we raised money from people after we owned it, which is, it's the opposite of the way that most people do it, but it takes the pressure off of needing to scramble to go raise the money. We can buy the building and then syndicate later.
Yeah, that's really smart. I haven't heard of anyone else doing that, but it makes a lot of sense. It's kind of like refinancing yourself out of the deal in a way.
That's what it is. Yeah, we call it recycling. It's a recycling of the money. And then that group that put the money up keeps 5% of each deal as an ownership group. So let's say that we're raising $1 million, that group will keep 50,000. And then a bunch of the people in that group will invest side by side with us, 50,000, 100,000 each. Our minimum's 25,000, so we can get people in who don't know us just to test us. But on our bigger deals, we say our minimum's 100,000, but that means we really don't want too many people to invest less than 100,000. And most people in a bigger deal will put in 250 or 400,000 or 500,000. And we just don't want to have the pressure of having to raise money to close. That's the key element of this, is why would we want to be pressured? We want to be able to say to a seller, we have the money ready to go. And then as we syndicate later, I get to know the investors. I want to know them. They want to know me. They want to know my partner. They want to know our succession plan, just in case I get hit by a truck. And they also want to know the details of the deal. And if you're jamming it together to raise the money, you're making up the details as you go. Once we buy it in this GP fund, we take our time structuring it when we really know what we're doing after we own it.
Okay. I guess the difficult thing that I see is just if you're just starting out, say like me, I'm trying to do my first hotel deal. So where do I start, like with getting the capital? So I think that's probably why most people do it the other way. But is there any way you would recommend in trying to get the capital first to do it your way?
Yeah, there is. The key for me to raising capital is going to investors and explaining what I'm trying to accomplish, even though I don't have a deal yet. And I line up a group where I tell them, when I have something, would you be interested in going into it? If it makes sense, I'll show you what it is. And I usually I practice. I talk to 3 potential investors every day, and I talk to 3 existing investors every day. So I have 6 investor calls a day, and it doesn't take that long because each one is 10 minutes, 15 minutes, sometimes even shorter. It's just a matter of, connecting to them. And then when it comes time to raise money for a deal, they're already aware that I'm working on something, and they know me, and they know that I've been in touch. I find that to be a really great way to keep the funnel. There's like a funnel. You tell 10 people about a deal, and then 5 people say maybe, and then eventually 1 or 2 of them actually invest. But I have to go to the 10. So if I'm talking to 6 people a day, and by the way, that includes Saturdays. So I'm really talking to 6 people, 6 days. So that means that if I really am getting 2 out of every 10 to invest eventually, that means I'm getting 4 or 5 or 6 investors a week who are seriously looking to do something with me.
Okay. That makes sense. Yeah, I've heard that similar approach, but not exactly having the cash already like invested in treasuries ready to go type thing. So maybe it's slightly different,
Well,
but I understand what you're
you
saying.
got to give something to your GP partner. So I share with them in acquisition fees, and I share with them in the backside carried interests. So they get more than just the return as an investor if they're in that particular little fund. We call that Brit co-sponsors.
Okay.
We're on our second one. We did one 3 years ago and it worked. So it was a 2-year commitment. So then we did another one earlier this year for another 2 years. And everybody who was in the original one, except for 2 out of the 40, went with us into the second one. What was really interesting is we did a flip. We actually flipped one property before we syndicated. So that group got the entire profit on the flip before the outside investors came in.
Okay, very nice. And in terms of industrial property specifically, I think that if you've been doing it for so long, it makes sense. But save someone that's not really familiar with that asset class, or say like an outside investor, like why invest in industrial properties compared to other ones?
Okay, so industrial has a lot of different asset types. There's different kinds of industrial. There's A, B, and C industrial. And the A industrial is, for example, in Dallas, when you're driving along the tollways, you see those monster big warehouse buildings. They usually have glass on the ends, which are the offices, and then they've got a line of truck docks in the middle. And they're very tall and they're very new and they're extremely attractive. They're painted different nice colors. That's A industrial. Those are buildings that are hundreds of thousands of square feet and even 1 million square feet and larger. And mostly those are occupied by distributors, not so much by manufacturers. A lot of Walmart might have a warehouse, and certainly Amazon has multiple warehouses, and companies, every clothing line has a warehouse. Car companies have car part warehouses. Those really big ones, I don't do that. That's not what we do. But you see those buildings. The ones that you don't see are the ones that are hidden away, that are smaller and older in industrial parks. Every town has an industrial park. Most small towns have something called Industrial Drive. And all around Industrial Drive, there are these little streets where they have buildings that are, let's say, 20,000 square feet, 30,000 square feet. And they're occupied by companies that make stuff. A lot of manufacturers, a lot of assembly companies, a lot of packaging companies, a lot of food companies. Anything in my office that you're looking at, or anything in your home, was made in an industrial building and then distributed from an industrial building to either a store or to you. And so industrial's everywhere. It's just people don't see it because it's behind the scenes. I'll give you an example. One of our buildings here in Chicago is occupied by a company called Eli's Cheesecake. They make cheesecakes. They do tens of millions of dollars in revenue, but they also make a pastry that's served on airplanes in business class and first class. And they also make products for Starbucks all around the country. So when you go to Starbucks and you see the baked goods, they're actually made by somebody. Those are made in an industrial building. Another one that's really interesting is when your little one goes to a children's museum, when they get a little older and they need some entertainment, every city has a children's museum. And one of our tenants has a workshop where they have 40 people making the exhibits that go into children's museums. It's called Red Box Workshop. So they have people working with wood and with metal and things that they make where kids play with water and sand and tubes where balls go running through tubes all over the place. And we also have distributors, like distributors of HVAC equipment. Every industrial building has a different use. And of our 15 buildings that we currently own, it's so cool what people do in them. Cabinet makers, people who cut big metal rolls and make little sheets of steel. that they send to manufacturers who take the sheets of steel and use it in machinery. So in Chicago, we've got 1.5 billion square feet, which is huge, 1.5 billion square feet. There's 16,000 buildings, 20,000 tenants. Dallas is a huge market also. And we own those buildings, and the tenants move in and they don't move out. They don't like to move. They move in for 5 years, they stay for 10 years, they stay for 15 years, because the cost of moving equipment and moving your employees is so great. So they just pay rent, and every year the rent goes up. So we like a nice 7 or 8% starting return that goes up every year. Maybe at the 10th year, it's up to 10 or 11%. And our investors love it because it's easy to manage, and all they do is get checks and we do it for them. So industrial is great. And industrial has been the hottest area of real estate investment for a few years now. They're actually knocking down office buildings and building industrial buildings. The Allstate Insurance headquarters was here in a town called Glenview in the Chicago suburbs. And a developer knocked down the buildings and is building 2 million square feet of warehouses. It's crazy.
That's very interesting. Yeah, I went to school with a friend that focuses on industrial. He's based out of Houston, and I saw a post of him talking about stuff like that too, just the substantial demand there versus supply. So could you talk about that a little bit more? I guess it's just like nationwide. Is that because like the move to more and more e-commerce and needing that distribution center and being closer to city centers?
Yeah, it's e-commerce, but it's also reshoring because of some of the political, let's say, unpredictability in China, where a lot of companies used to have their products made. A lot of them are bringing back some of their manufacturing to the United States. It's called reshoring. And they're making stuff here instead of overseas and then shipping it on a ship back to here. And what we're seeing is there's so much demand that there's hardly any vacancy. And that drives up lease prices, and it makes it difficult for companies to buy buildings because they very rarely come up. And because there's a limited supply, especially in what we do, which is the B and C, smaller, older stuff. If you owned a company, if it was the Mason company, and you made, let's say, knives for restaurants, and you were in a 30,000 square foot building in Dallas, if you wanted to move and buy a building of 50,000 square feet, you could stand on your head for 3 years, you wouldn't be able to find one because they rarely come available. So the supply is constrained and the demand is huge. And that's what's going on in every city around the United States, really in the world, is that industrial is hard to find, super hard to buy, much easier to lease, but not even easy to lease. So when we put a building on the market, especially in the city or near O'Hare Airport, which are what we call the infill markets near where the population center is, if we have a 30,000 foot building, we put it on the market for sale, we'll have 7, 8, 10 buyers. And they're all competing with each other. It's worse than the residential mess where you can't find a house right now in most places. In industrial, you can't find it, and it's because it doesn't exist. There aren't any. It's not even that it's slow. There are just so few buildings of that type that it even exist. And nobody's building any new ones because the reproduction cost, the replacement cost is way too high to build a new building like that.
To build a new,
it's a monster market. It's a monster market all over the country.
okay. When you say build new, like, I mean, I know there's not making any more of the B and C older buildings because, like, obviously that'd be brand new class A and like just very large. What do you mean not building?
There's nobody building small buildings in infill markets anymore because it costs $200 to $250 a foot, including the land cost, to build a new small industrial building. And if you were to buy one today, they cost about $120 to $150 a foot. So the replacement cost is so high that nobody would build anything like that. They'd be underwater if they built new. So the supply is even more constrained because nothing is being built that's new in the B and C small category. It would be an A building if you built a new building, but you'd have to tear down an old building to build a new building, which means you'd have to buy a building, not just land, and then tear it down and then build a new building. Now you're in for $250 a square foot. Whereas when the rare building does come on the market in that size, they sell for half of that. So people just wait it out. And sometimes if they can't find something to buy, they just lease and they get real unhappy about it. It's like, okay, I'll lease. I don't want to, but I will. And then they lease maybe in one of those newer buildings that are bigger. They just take a little piece. So now they're in a multi-tenant building instead of their own freestanding building. And now they have to put up with sharing a wall with a neighbor, worrying about parking spaces being used by the neighbor, an odor coming from the neighbor if they do something that smells bad, noises coming from the neighbor if they do something loud. So people love freestanding buildings, and that's where the constraint is. And those are the buildings that we invest in.
Okay, yeah, that makes a lot more sense now, because there are still new developments, but it seems like they're getting the economies of scale. It really needs to be a very large facility.
Yeah, a big building today, let's say Dallas or Chicago, a big million square foot building costs about $110 a square foot to build, including the land in most locations. Compare that to a B and C building that costs $250 to build, if you could find a place to tear a building down and build it. So they're building the big ones because there is a lot of demand from e-commerce, and they're still filling up all over the place. And at that price level for $110, you can make a nice 7% return if you can get $8 a foot net. And so that works. It has continued to work. But the cap rates, when they sell them to investors, are much lower than 7. They're selling them at 5, 5.5 today.
Okay.
Yeah, it's a crappy return, but institutions can't find anything to do with their money that's better than that. So they buy that stuff, and some pension funds have to pay the teachers who retire, and they buy an awful lot of real estate, and today they love industrial.
Okay. Well, it kind of brings me to my next question. Is that because it's very recession resistant, or why do they love industrial?
It's easy to manage. You can put a lot of dollars to work with one tenant. You don't have to have a live-in property manager. Like in a complex, multi-family complex where you have 300 units, people are moving out, people are moving in, there are parties, there's damage, there's painting, there's carpeting, there's fixing the kitchens, the parking lots get bad. It's a management nightmare. And people who are set up to do that do really well. But the returns on that are not as good as industrial, where you have one tenant. And the risk, though, is with multi-family, it's easy. If you've got 300 units and 30 people move out, you're still 90% occupied. You can pay your debt service. In industrial, if you have a single tenant building and they move out, you are vacant, 100%. And now you got nothing coming in. And by the way, that's why we do our deals all cash, because when they go vacant, if there's a downturn in the economy, you can't pay the lender. But if you don't put a mortgage on it, which is what we do, if it's vacant, you can carry it because you got the taxes, insurance, maintenance, and utilities, but no bank breathing down your neck.
Yeah, so you don't lose it to foreclosure. It makes a lot of sense.
No foreclosure. Banks have no sense of humor. I have learned in 2008, I got killed. I had 50 buildings and I had 50 mortgages, and the market was bad and people were having trouble paying their rent in industrial buildings like everywhere else. And it was a disaster for me and for my investors. And we went into the workout department at banks, and they are nasty. When you owe them money and you don't pay, they take it upon themselves to be difficult, obnoxious, rude, demanding. I just don't want to deal with those people.
Okay. Yeah,
Ever
definitely.
again, ever again.
Okay. So I guess the recession resistant component, that would really depend on the tenants to answer that question.
Yeah, I have a friend who went through the recession like we did. We had 50 buildings and a bunch of them became vacant. My friend only bought buildings with long-term leases with great credit tenants, like stock exchange listed type of tenants. And at the end of 2012, when I was just struggling to get back from deep in a hole, he said, I didn't even feel the recession. I didn't even know there was a recession. All my tenants paid rent and it bridged right over 2009, 10, and 11. And that wasn't our strategy. We didn't buy big buildings with major national tenants with long-term leases. We had a series of lease terminations that came up every year. And if a tenant was struggling and had to move out, we'd have a vacancy and we had mortgages. And so it depends. There's nothing that's recession proof. But if you have long-term leases and you have low enough leverage, it's recession better.
Okay. Yeah, that makes a lot of sense. I guess that could be applied to a lot of different property types.
But by the way, during COVID, multifamily did great and industrial did great because people had to go to work. People who eat chicken need to eat chicken. So the chicken manufacturing, where they process chickens, they had to go to work. You'd see on the news that in Iowa, a bunch of people were working in a meat plant and they all got COVID because they were chopping meat up, standing right across from each other in a very close space. But they had to go to work because you gotta have meat. And same thing is true of many products that were essential. So industrial buildings had to be open because you can't work from home if you're an industrial company. You got to go to the warehouse and either distribute it or make it. So the industrial buildings were very well used all through COVID compared to, let's say, offices, which were no longer occupied because people were working from their home office, from their dining room or whatever.
Well, that reminds me of another question. You said that that one office is being knocked down, but are there ever any conversions to industrial space instead of knocking down an office building?
No, they're not built right. The problem is that for industrial, you need loading. So office buildings, uh, the the multi-story ones, there's not a big enough elevator to move product up and down. And even if there was, the floor loads are not made to hold racks full of products, and the height of the floor to ceiling is too short because industrial buildings like to have tall ceilings so that people can put racks in and store stuff. And then if it's a single tenant office or a single story office, the ceilings were too low and the floors weren't thick enough because people walking on floors and having desks doesn't weigh a lot. But if you bring in heavy machinery, the floor just buckles underneath you because office floors are only 3.5 to 4 inches thick, and industrial floors are 6 or 7 inches thick. So, and they're reinforced so they can take the weight. So converting an office to industrial is about impossible.
When you say that makes a lot of sense, yeah, from all those different angles. And that's the thicknesses of concrete, like the foundation of the building.
Yeah. Same with retail. Retail stores, the old Kmarts that close and other stores that close, the floors are not thick enough to handle industrial forklift trucks with all the weight on them. They'd have to tear the floor out and put in a new floor, which would cost probably in a Kmart something around $1.5 million to $2 million. People wouldn't do it. And there aren't
Okay.
enough truck docks. You need one dock for every 10,000 square feet of warehouse. So if you take a retail building and you turn it into industrial, it might have 2 docks. If it's 60,000 feet, you need 6 docks. So there's a bottleneck of stuff coming in and out through the dock because the docks are at the level of the truck. You can't use an industrial building very easily if it's got a ground level drive-in door, because how do you unload from 4 feet off the ground? You have to have a forklift truck drive from the floor of the building into the truck to pick up the product in the truck and then back up with it. So if there are just too few docks it doesn't work. And that's the problem. And with office buildings, they usually have no docks. If a large office building, multi-story, has one dock, that's a lot. So they couldn't be used for industrial. They have to be torn down, take it off the site. What they do is they grind up the building and they put it under the parking lot. It's just like, just rubble, ground up, spread around, and then covered with asphalt. And then they build the building next to that.
Huh. Okay. Interesting. Not like a parking garage, like multi-story concrete parking garage. It's like just a black asphalt open parking lot.
Yeah, wide open.
Okay, that makes more sense. Huh. Yeah, I've seen like people actually specifically a old Kmart store being converted to like a self-storage facility, but I think it's a lot easier when you don't have heavy equipment, all that stuff.
Yeah, a lot of buildings are converted to self-storage, and that works because it's not that heavy and you don't really have forklift trucks. You got those little carts that you put your stuff on and you move them around the aisles. There's no weight to it. And if you put your couch and your table or some files in one of those self-storage units, that's not heavy stuff. And they don't need high ceilings. If it's a single floor that's been converted, they just have the garage doors separated by metal panels. And so it's really easy to convert those, but not to industrial.
Okay. I'm running out of questions here, but one thing I wanted to ask you, it seems like you primarily focus on Chicago area, but do you own anything outside of that area?
So we had a building in Columbus, Ohio. We had one on Long Island, New York, and we had two in Florida. And what I learned is that being laser focused on one location is better for us because we know our market cold. As I said, I cold call, my whole group cold calls in person. We know the areas, so we know the values. As soon as we go to someone else's market, someone besides us knows far more than we do, and they're going to eat our lunch unless we get lucky and values are just going up and anything you buy goes up. That's true in the stock market and everywhere else. If you buy while everything's going up, it's hard to be stupid. You look smart because you bought. But when things get tough and there's always a downturn around the corner, knowing our market, making sure we pay the right price for the right buildings with the right amenities is important. And we know Chicago so well. The brokers know us to bring us tenants, not so much deals to buy, but they bring us tenants. There's 300 industrial brokers in the Chicago area. Many of them are members of the Society of Office and Industrial Realtors. I got that wrong. Society of Industrial and Office Realtors. There's a lot of them in Dallas. They're all over the country. They're all over the world. And these are the highly sophisticated, extremely experienced industrial and office brokers. So we know them, and that's important. They do bring us deals to look at, but we also know the tenants, and we also know each park and the nuances of how much is a building worth on the south side in this location versus the north side in that location, because the demographics are different. The access to the highways and tollways and to the rail yards, which is important, are different. And the closeness to the city where there's high density, and the closeness to the airport where people who come in and out of town from various places to look at machinery that might be in a showroom. We know the nuances because we're here. And I've decided with 1.5 billion square feet, I'll never run out of learning what I don't know in this market by itself. And that gives us an edge over people who come here from out of town.
Okay. Yeah, that definitely paints a convincing picture. So I'm sold. That makes sense. Great. Well, what kind of person are you looking to get in touch with if someone's listening to this and wants to reach out to you?
Well, a family that wants to sell their industrial building in Chicago is one, which if somebody knows owners of properties of that type, they're hard to find. It's usually through networking or cold calling. And investors who are accredited, that already know about real estate. I don't want to teach anybody the real estate business. I want people to join us who already like real estate and just want to be in our asset class with our experience to help them do well and get a good return in a safe way. So if somebody's looking for a safe deal where there's no debt and where the operator, the sponsor knows an awful lot more than everybody else, we're looking for those people to talk to us.
All right, perfect. And what's the best way to get in touch with you or your team?
We have a website. It's Brit Properties, BRIT, 1T, properties.com. And there's an article, that says why you should not invest with us. And it's the 10 questions that you should ask before you invest with any sponsor, such as what's your succession plan if you die? And, why are you interested in having such low debt, and doesn't that affect the returns and things like that? So it's an article that I like people to read before we talk to them so that they know the tough questions. How about how many deals have you done where you've lost money? Because the guys who say, I've never lost money, they're going to learn a lesson on somebody else's investment because they don't know how to lose money. If you haven't lost, when it happens, it devastates you, and often you go into a panic. And nobody wants to invest with someone who's in a panic.
Okay, great. Yeah, I was actually looking around y'all's website. Y'all have a lot of great resources there, and I read some interesting stories. Some of the people that you spoke with when you were touring different properties too.
Yeah,
A lot of good read material.
it's a fun business. There's so many different kinds of tenants and owners. Seeing what people do is just so fascinating. Things you never heard of and never thought of, and you say, "Oh, someone does that? I didn't know someone did that."
Yeah, exactly. All right, excellent. Well, yeah, I don't want to take too much of your time. I really appreciate you taking the time to jump on the show. I think this has been really interesting and valuable, and hopefully folks have learned a lot from it and reach out to you.
Mason, thank you very much.
Hey guys, I appreciate you taking the time to listen or watch this episode. As you might have noticed, we don't run ads, but what I would like you to do is just subscribe to our YouTube channel. That would help us out tremendously. You don't even have to leave a review, but if you do feel like you would gain a lot of value from this episode, feel free to share it with your friends and comment, like, subscribe, all that. But subscribing to YouTube would be what helps us the most. That's the only thing I ask. Thanks a lot. And if you do want to get in touch with me, feel free to email me at mason@scalablerei.com. Thanks a lot.